there are many challenges associated with complying. Some of these have to deal with your forms vendor as well as your software providers. These issues can include not having the correct name and address of the federal agency. This can occur when a software update or when you're implementing a new software. In addition, sometimes the credit score ranges are pre-filled, and each consumer reporting agency uses a different score range. Depending upon how this information is transposed to the adverse action notice, it may be incorrect as the score ranges do change from time to time. Some other issues along these lines are the key factors don't match what is on the credit report. This can also occur when they are manually input rather than populated directly from the credit report. Another issue has to deal with drop-down boxes within your software. In some instances, the provider has made the reasons for denial too vague. The reasons for denial should be specific, and we recommend that they are in alignment with the reasons noted in Reg B's model notice. So how do we know if we should include the credit score and related disclosures? To assist in determining if the credit score disclosure should be included on the adverse action notice, ask yourself if the credit score was used in the decision process. This is where the interpretation comes into play, and we have seen regulatory agencies apply this differently. We have seen the examiners indicate the credit score disclosure is required if the lender has a minimum credit score requirement on its loan products. Some institutions have tried to argue this point with the examiners, indicating that they don't use the score in their decision process, to which the examiners replied, then why do you have it on the credit report? Because you can obtain a credit report without having the credit score. And I have to say that is a pretty good argument. If we take this thought process and apply it to our loan products, if you are doing any type of loan level pricing adjustments or have a minimum score requirement, we would recommend you include the score when taking adverse action. At this time, we would like to review an example of when FCRA disclosures are required for business loans. In walking through this first example, Mary is applying for a loan as the sole proprietor for a business loan. Since the applicant is by an individual, there is a permissible purpose to obtain a credit report. Based upon information in the credit report, the loan is denied and the FCRA disclosures for use of the report in the credit score are required. In the next example, Mary is applying for a loan in the business name, and Mary will not be applying individually or acting as a guarantor. The lender does not have a permissible purpose to obtain a credit report in this instance. The request is denied. However, as a credit report was not obtained, FCRA disclosures are not required. In the next example, Mary is applying for a loan in the business name and does obtain an intent from Mary to be a co-obligor or a guarantor. So in this instance, we do have a permissible purpose, and the request is denied. If Mary was to be a co-obligor or a co-applicant, then the FCRA disclosures would be required. If Mary was to be just a guarantor, FCRA disclosures would not be required. When a creditor obtains multiple scores but only uses one in making the decision, the creditor must disclose the credit score that is used. The regulation doesn't specify which score should be used if the creditor uses all three, other than you have to disclose a single credit score that is used by the lender in making the credit decision. The creditor should have policies and procedures established to determine which of the multiple credit scores is used in taking adverse action. If you use 3 scores to make your decision, then choose one of the 3 that was used and report it. If you use 3 scores and you use either the high, middle, or low, or most recent, report the one that you used. If you pull 3 scores and average them, choose one of the 3 that were used and then report that. But what happens when there's no score? In some cases, a lender may try to obtain a credit score for an applicant, but the applicant may have insufficient credit history for the consumer reporting agency to generate a score. The regulation only applies when a creditor uses a credit score in taking adverse action. The creditor cannot disclose credit information if an applicant has no credit score. Nothing prevents a creditor, however, from providing the applicant with a notice indicating that no credit score was available from a consumer reporting agency, although the regulation does not require you to send such a notice. Reg B indicates that only the primary applicant needs to receive the notice. However, FCRA requires that if the credit report and score was obtained and used in the decision process, a separate notice should be provided to each applicant. Nothing in Reg B prohibits you from providing separate notices. What internal controls do you have established to ensure compliance with the requirements of adverse action? Policy and procedures should always be first on the list. The procedure should involve each business unit and any workarounds that have been established for your software programs to produce an accurate notice. Next, implement a second review of the adverse action notice before it is provided to the applicant. You probably have a second review process established for the actual denial. You could enhance this process by including a completed adverse action notice for the individual performing the second review. What about those verbal notifications? The business notification requirements can be given verbally, but how is it documented? While it doesn't have to be written, how do you prove that a notice was provided and the time that it was provided? Without this notation, you can't demonstrate that you met the timing requirements. We recommend you notate your files in a conversation log or similar document that indicates the employee that provided the oral notice and the date that it was provided. Training should be conducted based upon changes to your procedures as well as changes to the regulations and the results of recent audits and exams. Be sure to incorporate your actual procedures as part of your training. Independent monitoring and audit is an effective tool to determine that your actual process is in line with your written procedures and the regulations requirements. The frequency of these reviews should be based upon your monitoring results as well as audit and exam results. If you have a question you would like us to answer, we'd be happy to provide you with a further explanation or a further answer.